Hey everyone, and welcome to this high-energy explainer masterclass. Look, if you're targeting that A-star grade in IGCSE Accounting 0452, you are in exactly the right place. Today, we're tearing down the basics and rebuilding your knowledge with our advanced technical methodology. This isn't just about simple record keeping. It's about bridging basic data entry with high-level financial intelligence. I'm your subject specialist, and to make sure we hit every single grading requirement, I'm joined today by our resident senior examiner.
Absolutely. It's great to be here. We're going to guide you through the absolute foundational core of the syllabus, right up to the advanced investigative skills that we examiners are desperately looking to see on your papers.
Okay, let's pull up our agenda, the Mentors Masterclass. We'll start with core accounting foundations, hit step-by-step technical execution, dive into AO3 interpretation and evaluation, reveal some examiner secrets and fintech, and then wrap it all up with the A-star final challenge.
Subject Specialist. Section 1. Core Accounting Foundations, the Architectural Requirements. Let's get right into it.
So we have to start right here. Assets equals liabilities plus equity. You know, this isn't just some formula you casually memorize for a multiple choice question. Maintaining this specific accounting equation at all times during the fiscal period is literally non-negotiable. Every single transaction you process, every entry you make, it ultimately has to keep this scale perfectly balanced. If it doesn't, the whole foundation cracks. And that balance, it's maintained by the concept of duality. Think of duality as a physical law of the accounting universe. It's kind of like gravity. It demands that every single financial transaction has a twofold effect on the business records. Like, if a business buys a delivery van with cash, the asset of vehicles goes up, sure, but the asset of cash goes down. It's this automatic, dual reaction that keeps our foundational equation perfectly level. Now, what's really fascinating here is the constant tension between recording exact numbers and being incredibly cautious. On one side, you've got the historical cost principle. That dictates we record an asset at its original purchase price. But on the flip side, there's the prudence concept. Prudence ensures we never overstate our profits by ignoring potential losses. For an A-star student, understanding the push and pull between these two concepts is absolutely crucial. This tension, that's exactly where we examiners test you in complex, multi-layered business scenarios, like when you have to decide how to value aging inventory or doubtful debts. Speaking of doubtful debts, pay very close attention to this. For the syllabus 2028-2030 updates, Cambridge requires 100% accuracy with modern international terminology, so you must use irrecoverable debts instead of the old term bad debts, and owner's equity instead of just capital. Utilizing these precise terms, that is the exclusive intelligence that separates the true A-star candidates from the rest of the pack. You gotta get this right. All right, moving on to Section 2. Step-by-step technical execution, the method over math strategy. So every piece of data follows a specific procedural flow. You begin by identifying the correct business document, like an invoice or a credit note. That acts as your source for the books of prime entry. From there, it flows straight into our T accounts, which honestly remain the gold standard for representing the double entry system. You balance those accounts with your balance brought down and balance carried down, move into the trial balance, and finally, seamlessly transition into the financial statements. It's a continuous logical pipeline that builds momentum as you go. And here is exactly why that pipeline matters. Method marks are rewarded even if the final balance is incorrect, provided the logical flow is visible. This right here is your method over math mantra. In an exam, if you miscalculate an adjustment for depreciation or inventory valuation, do not panic. By meticulously showing your workings in those T accounts, you prove your logical flow to the examiner. That secures vital method marks, even if your final calculation is slightly off. Always show your work. A really common mathematical pitfall where you will desperately need those method marks is confusing trade discounts with cash discounts. Listen, trade discounts are bulk deductions right at the invoice stage. They don't even make it into the double entry system. Cash discounts, however, are procedural incentives for prompt payment and absolutely must be recorded in the discount allowed or received accounts. Mixing up the percentages and the placement of these two during the prime entry phase is a classic examiner trap. Don't fall for it. Let's jump to Section 3. AO3, Interpretation and Evaluation, Diagnosing Business Health. Let's elevate this explainer and really dive into AO3. Calculating the math is a baseline skill, but AO3 is where you interpret the results to define an A-star response. Imagine a current ratio drops drastically from 2.5 to 1, all the way down to 1.1 to 1. As an investigator, what does this visual shock actually mean to you? Calculating the ratio is just step one.
An A-star candidate looks at this massive drop in liquidity and immediately starts asking questions.
Right, so why did the ratio drop? We need to dynamically debate the cause-effect chain here. Has inventory been massively overpurchased, basically tying up all our liquid assets? Are trade payables being settled way too slowly? Or conversely, did we drain our cash reserves due to a huge capital expenditure? Debating these potential causes and diagnosing the why behind the numbers, that is the ultimate gold standard of evaluation.
But to truly evaluate, we have to look beyond surface numbers, especially when you're comparing different firms. For example, one firm might use straight-line depreciation, while another uses the reducing balance method. That makes direct numerical comparison incredibly difficult. Because of that, you must analyze the quality of profit by looking at non-financial factors. Things like staff morale, business location, and market reputation, they aren't on the balance sheet, but they heavily impact long-term sustainability and your return on capital employed.
Okay, Section 4, Examiner Secrets and FinTech, the Real-World Test.
It's time to reveal some exclusive examiner secrets from the 2024 and 2025 reports. Listen closely to these vital pieces of insider intelligence. First, poor handwriting in ledger accounts literally loses marks. If we can't read your balance brought down, we just cannot award the point. Second, poor time management across question weightings will absolutely sink your grade. But you know what the absolute most lethal warning is? The failure to distinguish between revenue and capital items. Treating a long-term asset purchase as an everyday expense will completely distort the financial statements and destroy the accounting equation. It's a massive red flag. To help you avoid these mistakes when exam pressure peaks, here's a pro-tip memory hack. Dead click. Debit, expenses, assets, drawings. Credit, liabilities, income, capital. Seriously, when you're staring at a complex, multi-step problem and your mind just goes totally blank, write dead click at the top of your paper. It's your ultimate safety net for locking in the core rules of double-entry bookkeeping.
And why do these rules matter outside the classroom? Well, consider this 2025 real-world case study. Modern AI-driven accounting software, like Xero, executes these exact foundational rules seamlessly. Xero's AI handles the duality, balances the ledgers, and maintains the assets equals liabilities plus equity equation automatically in real time. So what you're learning manually right now, it's the exact algorithmic logic that powers the cutting-edge fintech industry globally. Pretty cool, right?
Subject Specialist. Finally, Section 5, the A-Star Final Challenge. Pause and think.
All right, here is your challenge. If a business buys a machine and pays for its installation, is the installation a revenue or a capital expenditure? And deeper still, how does the prudence concept apply to how we actually record it? Subject Specialist. I want you to mentally solve this cause-effect chain right now. Think about it. Does it add to the value of the asset, or is it just a day-to-day running cost? Get this right, and you're well on your way to conquering your exam. Keep practicing that logical flow, rely on your method marks, and we'll catch you in the next explainer.